We need to have a serious conversation about market structure because what is happening in the silver market right now is not normal price action. This is not a routine rally, not speculation, and not hype. What we are witnessing is a systemic breakdown in price discovery itself. When you see a limit-up trading halt appear on your screen, it doesn't simply mean price is rising too fast. It means the system designed to discover price has failed. Exchanges use circuit breakers to halt trading when volatility becomes dangerous, not for the public, but for the banks. Today, we are going to explain how these halts work, why they are happening now, and why they are the clearest signal yet that physical silver shortages have overwhelmed paper leverage. This is not theory. This is the mechanics of a default unfolding in slow motion. To understand how serious a trading halt really is, we need to look back at history, specifically the 2022 nickel crisis on the London Metal Exchange. When a massive short squeeze sent prices vertical, the exchange didn't allow free market price discovery. Instead, they shut down trading, canceled completed transactions, and rewrote the rules to protect institutions that were too big to fail and too exposed to lose. What we are seeing in silver today is the exact same setup. A limit-up halt is not a pause for stability. It is a desperate attempt to locate liquidity where none exists. The game is stopped because the exchange is running out of chips. The reason for this halt is simple but terrifying: a liquidity vacuum. In a healthy market, every buyer has a seller. But as silver approaches critical psychological levels, sellers have vanished. Miners are holding back supply because they expect much higher prices. Bullion banks are terrified to increase short exposure because many are already functionally insolvent. This leaves a one-sided market filled with buyers and no sellers. When billions of dollars chase zero available supply, price gaps violently, and the circuit breaker trips. The halt is not control. It is the system screaming for help. This leads us directly to the paper-to-physical ratio. The COMEX is a leverage machine. For every ounce of registered physical silver, there are hundreds of paper claims trading against it. This works only as long as nobody asks for delivery. But confidence is breaking. Paper holders are rushing for the exit, attempting to convert contracts into real metal all at once. The trading halt is the exchange locking the theater doors while the fire is already raging. It traps capital inside the paper market to prevent a physical vault drain. This is why holding SLV or unallocated accounts during a halt is so dangerous. You cannot sell, you cannot redeem, and your capital is frozen by rule. Meanwhile, the physical market never stops. Coin shops, private dealers, refiners, and OTC desks continue trading even while screens go dark. During the nickel halt, paper prices froze while physical prices exploded. That decoupling is the most dangerous phase for paper investors. You think you own silver, but what you actually own is a frozen claim on a stressed or bankrupt counterparty. Industrial users understand this. Companies like Tesla and Samsung cannot afford halted markets. They need silver to keep factories running. When futures shut down, they move to OTC channels and pay whatever premium is necessary. This shadow market reveals the real price, often far higher than what the public sees. Algorithms are accelerating the chaos. Modern markets are dominated by high-frequency trading bots programmed to chase momentum. When silver breaks a key resistance level, thousands of algorithms attempt to buy in the same millisecond, creating flash rallies that trigger halts. The irony is brutal. Banks built these systems to control markets, and now the machines are breaking them. The only way to stop the damage is to pull the plug. As halts lock shorts into losing positions, margin calls intensify. Losses continue even though positions cannot be exited. Exchanges demand more collateral, draining liquidity from hedge funds and banks. To raise cash, they sell stocks, bonds, and crypto. This is how a silver squeeze becomes a global contagion event. Pain in the silver pit spreads across the entire financial system. History shows that halts are often followed by rule changes. Margin requirements may be raised to 100%, killing leverage and forcing smaller players out. Officials will claim it's about stability, but in reality, it's about suppressing demand. The rules are changed mid-game because the house is losing. Meanwhile, regulators remain silent. When manipulation fails and prices rise, intervention appears, not to protect investors, but to protect banks. A trading halt is government intervention, pure and simple. Smart investors see these halts as validation. If silver were meaningless, they wouldn't need to stop trading. They halt it because silver is the Achilles heel of the fiat system. Every halt compresses the spring further, guaranteeing that the next move will be even more violent. Globally, the implications are massive. China and Russia are watching Western exchanges fail, accelerating the shift toward Eastern pricing power through platforms like the Shanghai Gold Exchange. Liquidity is migrating. The West is losing control of commodity pricing because its casinos are broken. For physical holders, this moment brings calm confidence. A trading halt does not change the weight of the coin in your hand. In fact, it makes it more valuable. When electronic systems fail, tangible assets become king. This is why we stack, not for daily price swings, but for the moment when screens go dark and reality takes over. Looking ahead, expect volatility, psychological warfare, and attempts to smash prices once markets reopen. Do not be fooled. The fundamentals have not changed. The shortage is real. Inflation is real. Debt is real. If the exchange cannot restore order, they may declare force majeure and settle contracts in cash, an outright default. At that point, paper and physical prices will completely disconnect. This is not a sprint. It is a marathon toward fair value and remonetization. The chaos you hear is the old system dying. You cannot print silver. You cannot halt supply and demand forever. The dam is breaking, and those standing on the high ground of hard assets will be the ones who survive what comes next.